Hey, this is Jeff Scott and welcome to this week's video. Open up my file. Had some technical difficulties. Hopefully we'll have sound and I won't have to do this again and kill another hour. Interesting week. Started off strong and then apparently the market caught coronavirus as my portfolio started to take advantage of some of the protection I put in. But just like buying disability insurance, you really never want to use your protection. I titled today, Has Coronavirus Killed the Bull? Today's the 23rd. My email address is hgsidoc@gmail.com. As always, it's for education purposes only. I'm a doctor, not a broker. I have no Series 7 or any other license that would say that I know what I'm doing, nor should I be telling you what to buy. So anything you do is purely your own decision. I am an independent person. I do not have any financial affiliation with any software vendor or trading company, and I've paid for the tools that I use and I demonstrate. Trading involves risk. You and your owner are solely responsible for any investment decisions you make. From time to time, I will use options, and I refer you to the Option Industry Council for their wonderful website and disclaimers about why options might be risky. Don't need to spend much time here. I really always like to call out those people who've influenced me. And I started with Cancelim as improved by Ian Woodward, and John Person really taught me how to make money trading. And I'll mention some of the other folks as we go through. I own a lot of technology, software, etc. Kind of what I use on my screen if you came in during the day would be TradeStation and Thinkorswim. I've got different packages for those. Genesis is actually a great platform that nobody uses anymore, including me, but I've got some things I bought for it, so I still use it for some of the scanning. I do most of my analysis with Hgsi and EdgeRater, Cigars, Q tools, and I'll talk more about Dr. K tools. I've introduced Dr. K's tools over the last couple of videos. I had a lot of questions about them, and one of the things I mentioned was I would talk to Dr. K and see if I can't get some special deals for people who watch my webinars. A key point to point out is that I make nothing on these. When you go to a webinar that's sponsored by one person and introducing you to another, assume, in most cases, unless told otherwise, that part of your hard-earned money is going to the person who sent you the invite. I elect not to take that money, but rather to apply it towards a discount that you will get. So I get nothing. HighGrowthStock.com is the website, 30-day trial for HGSI. Under investing strategies, you'll see hundreds of movies by myself and others. Stock patterns are cyclical. HGSI stocks have a tendency to go up like rockets and fall like rocks. You saw that on Thursday or Friday. And again, age-old story. Are we about to begin stage 4 with a significant sell-off, or do we have maybe 4 to 7% to drop, which will still be painful, which would be sort of the low road scenario that I talked about last week? I think there's a good chance, but you know, the way this market's been with quantitative easing and central governments and bankers, we could take another leg up. It's all news driven. I have no idea. You have no idea. I'm just betting that we don't have a 2008 style market collapse in front of us anytime soon. So since I've got uncertainty here, I have taken smaller positions and sold premium. I put some puts on, and I bought some contra ETFs. I am not all in on the short side. I'm still probably a little bit longer than I am short, but I'm not naked long with no protection. I've also expanded my gold position as of late. I always like to take a step back and look at the individual S&P sectors. HGSI, for whatever reason, didn't have the XLRE, so I populated it with a different ETF. The others of these are the stocks that actually represent the current S&P sector. So I like to look at this, and you can see real estate was strong. Utilities were strong. And staples looked like they had more green than red. Those are defensive. So clearly utilities in real estate were leading, and this was a shift to defense the last couple of days. If we go and look at the major markets, let's see what we got here. Give it a second to boot up. This is weekly. I want to look at daily, so let me just go ahead and change this already. My bad. So I'm going to enlarge this here using the maximize cell, which will eventually come up. So I like to look at futures because they tell the whole story, not just what happened between 9:30 and 4. Although in Hgsi I'll use the cash indexes. So just look at the 1 year's worth of the E-mini futures. There are a lot of stories on this chart. Story number 1, we hit the high of the year, which happened to be all-time high intraday on Thursday, and then the market sold off, and then it pulled back towards the open a bit. Friday was another down day, pulling into the 17-day moving average. There was lots of volume on Thursday and Friday, but I also know, because I do a lot of options, it was options expiration day, which is probably part of the volume. As I look through here, I see that there have been a number in the last year, 1, 2, 3, almost 4 touches of the 200-day moving average. From this point on, that's a pretty significant drop, but it's not that unusual for markets to come back to the 200-day. There have been multiple touches of the 50-day moving average on the downside and near touches, and that might be in yellow more likely destination. Still a big drop from here. How can you be bearish on this picture? Well, except for the last 2 days, there's not a bearish thing on this chart. But I think we've had a long run, and like everybody else, one wonders when the next leg falls. If I look at the NASDAQ futures, I have nothing different to say. Again, robust volume, maybe it's expiration, and it too has had multiple touches of the 50 in yellow and the 200-day moving average in red. If I look at the Dow futures, it's about a week ago that it had an all-time high. Let me make sure I get the same amount of data on here. And a little bit looser than the other two, very close to the 50-day moving average, and thinking that a 50-day touch is likely on the Dow is not a big stretch. If I go to the next one, I have the Russell futures. Now, it looks like the Russell set a new high last month, but reality, the Russell new high has not been taken out for 2 years. The Russell kind of a sideways move the last week or so, while the rest of the market's been powering higher. The VIX spiked, and that's a sign of market entropy. When the VIX is high, it's time to buy. When the VIX is low, look out below. Well, this is low. This is high. This is higher than low and higher than it's been, but it's certainly not an extreme. So if the VIX continues to go up, you'll feel pain in the market. And the dollar really eased on Friday, which helped my metal position. If I was to look at the weeklies, I'll just look at them in the PowerPoint for the sake of speed. You can see the long move we've been in the top 3, the E-minis, the NASDAQs, the Dow futures, and the much less tight, more, what's the word I would use? The more volatile, the Russell. You can still see the VIX is in the lower part of its world, and the dollar had a shooting star on the week. Now, what's underneath? Rates fell as the number of coronavirus cases rose. This is not a good thing. These falling rates is not evidence of the Fed trying to stimulate the economy. These falling rates are evidence of concern that the economy is going to have a major slowdown related to what's going on with the virus. If we look at the 2-10-day spread, it has continued to fall. It's about where my arrow point is, so it's a little bit still above the area that we get worried about recession. If I look at the AD lines, they just tucked down a little bit this week. They're still near all-time highs, as even the Russell has tried to catch up with its past highs, as you could see back here. If I look at the NYSE and the major ETFs, the message you should take from this slide is that, interestingly, transports turned up last week, while everything else turned down except for the strength in this light blue, which is bonds. Breadth weakened. You can see number of stocks above the 200-day on the left, above the 40-day on the right. Both came down, are still in the middle of the range on the shorter term. And if I look at the T2121, the 3-month or 12-week, 13-week new high, new low, you can see we've come down to a neutral position. We were getting close to overbought, and we are undid that with this week. Daly McClellan, if you want to be bearish, you still got substantial divergences we've not taken out and closed the divergences that I wrote about back here. Current buckets. Now here's a neutral picture where we have pretty much the same number of stocks below and above the Bollinger Bands and almost a 50-50 split above and below the midline. The good news is maybe the market's not as bad as it felt. And the bad news is we still have a long way to fall. If we have to fall, we're nowhere close to a reversal. There was no evidence of a Hgsi this week, but we're still dealing with some Hgsis from earlier in the month on both the NASDAQ and the NYSE. I'm not putting a whole lot of merit there, except I would be nervous now with this market anyways as we deal with coronavirus. Market tone, you can see we've pretty much gone neutral. There's still some strength with some green left, but it's far from what we saw in October with the red, and again in the end of January with the sell-off. Now we could still get there, and all it will take is a line of kahunas to the downside. Sector strength, interestingly, there's still a lot of green here, and as I mentioned before, led by defensive sectors. Now, other ways to get a sense of what the market's doing. Now, we know that Microsoft, Apple, Amazon, AMD, and a number of other big movers got hit this week. How do I know that? Because I own most of them, although fortunately I have puts on the majority of them. But let's look at some other, let's broaden that out a bit. The canaries, for me, as you could see here, Apple, Amazon, Netflix, bookings, Google, Baidu, Facebook, and Tesla. I know it says Priceline, but I just haven't updated that. I certainly updated what's in the price chart. What do you see here? You see a very strong, non-sustainable, frankly, run in the canaries. You see a high on Wednesday and a shallow pullback on Thursday and Friday. That's even a falling wedge, perhaps, and that's a bullish pattern. It's a flag, whatever you want to call it. It hasn't broken the 8-day exponential yet on a close. Hard for me to be really bearish on that picture. Let's broaden it to my index of January 19th, which is broad spectrum. Many of these stocks have blown up already, but look at what happens here. The index, it started to go a little bit more sideways than up. It's in a squeeze, and it's still above the 17-day moving average. So a pullback at the top, but I would not by any means say that it's broken. News this week. We got some Fed heads speaking. We got weekly jobless claims on Thursday. And on Friday, we got some inflation numbers, PMI, etc. I would put this in the medium of news. I don't see Powell's name there, and I don't, you don't have the monthly unemployment numbers. What you do have on the right is still another week with lots and lots and lots of earnings. Now, this looks like some retail, some drug stocks, some of the big, you got JCPenney's, which used to be a big company. Some of the big techs are already done, but you still have a lot of things. As it says in the lower right-hand corner, judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. So what are my thoughts? The markets hit a wall and sell off beginning on Thursday, led by large cap tech. Is this impact of extended markets, weak services PMI? There's talk of hedge fund collapses relating to Tesla short positions, or did the markets just catch a little coronavirus? Clearly, coronavirus is starting to pop in other parts of the world, and the word pandemic is being used. Still quiet in the U.S. Impact this on world economics. Our concern is causing increased nervousness and leading to a flight to safety, and that's why I think we're seeing bonds rise and gold has hit a multi-year high. Most indices remain up on the year, but returns dipped on the week. Mine dropped down to 34% up on my reference portfolio. For those who haven't been here, I started with 1.7 million in my trading account, and that's the account that we're measuring. I take capital out to live on, like probably many people do off their trading account. But I look at one thing, and the only thing that really matters to me on my performance is how much money I make. And that is something that I do share, and maybe I shouldn't share, just so you know that I'm not playing with you and lying. So I gave up some this week, and I have a number of protection positions on. So if the market bounces immediately, I'll probably not bounce as much, but I sleep easier having protection. When I say protection, my largest position is Amazon. I have puts on my Amazon. I never buy at the money puts because they're too expensive, and the market has dropped enough that my puts are above the price of Amazon. So I'm pretty protected if Amazon falls. But if it bounces, some of the bounce is going to eat up the premium on my put. I have puts on my Apple. I've got puts on my Bank of America. Those are probably my three largest positions. I bought Nugget. I bought AU, Ashanti Gold. I've got SLV, and I've got Silver Wheaton or Wheaton, whatever, on silver. And I also added some SDS to play a contra ETF to the S&P 500. And I've been short for 3 days, triple Qs or TQQQ. So we'll see what happens in the market. I hope it goes higher because I'm still more long than short, but I want to buffer any drop in the market. And then the other thing is it'll be interesting to see, sorry about that, the impact of coronavirus versus more quantitative easing. It's hard to believe that the central bankers will sit tight with the world economic recovery already on the ropes. China has already eased several times. Who is next? And this week is still busy for earnings, and market has been punishing misses. Now, one thing that newbies don't always realize, there are probably 5 or 6 elements that matter on an earnings report. You have earnings reported from the last quarter. How did that compare with their projections? You have revenue from the last quarter. How did that compare? Then you have whisper numbers. They may say that the company was going to make $1, but the people in the know think they're going to make $1.10. Well, if they make $1.05 and you see that compared to $1, you're all excited, but then the stock falls. Why? Because there's a whisper number on both earnings and revenue. And then what about projecting the future? A lot of people have been talking about slowdowns related to coronavirus. Heck, if I was in a public company and I was concerned about my quarter, I'd blame it on coronavirus too. So you have to worry about that. So you got 6 data points. Any of those 6 can sink your stock. So you got to be careful holding into earnings, especially with the coronavirus story. Now, again, as mentioned over the last several weeks, I've talked about Dr. K's tools and how I use them and why they become an important part of my analysis. His approach to seasonality is unique. He paints future projections on a TOS weekly chart, and he has watch list columns of 20, 40, 60-day moves. I got to know Dr. K because he's got this interesting approach to the Laguerre RSI, which is an oscillator, which you can probably find at Laguerre RSI on the web somewhere. He modifies it some, but he also has built a scan and watch list columns to find stocks that are firing, similar to stochastics, again modified. And then he offers mentoring in addition to the seasonality. So I reached out to Dr. K. I bought the stuff at retail, of course, and now I'm going to find a deal for you. So Dr. K has offered to combine parts of this at a deep discount to what you would buy it on your own. As I said, I get no affiliate fees, I get no commissions, and I just ask each of these people that I talk to bring into the family to give it out and discount whatever I would get for what you pay. This is not a component of HGSI, but like many of you, I do use more than one tool. And like many of you who I've communicated with, I'm very frustrated by the existing seasonality programs on the market. So package number 1, this package will get you the indicators that I mentioned, the Laguerre RSI and scanner and columns and the Stoke. But what it really will get you is this. It'll get you the, go into Market Watch. It'll get you a scanner looking for daily RSI signals. and stochastic signals. And it will get you this scanner here where if you've had +8 or -8 in either 20, 40, 60 days percent return going back, I believe 12 years, it'll give you a 1 here, and then you can identify stocks that are likely to have a good move. So let's look at EVRI, and I'm just going to look at it on my charting, and I'll point out some of the things that I get on the chart from him. This is really the money. He's projecting back here what historical data for 12 years suggests the market will do. Remember, it's 8 years on the columns, 12 years on this. What the market will do. In this case, it's at EVRI. And this blue is sort of following what it's been done and predicting where it's going. I find that to be extremely valuable, that I don't have to go and flip. The other part that he does, the Laguerre RSI, he fired on Friday. This is the Laguerre RSI, and I'm not sure why it painted green. Maybe it didn't paint green. Let's see. Yeah, it did not paint green. It's not a buy on the Laguerre RSI. It's neutral. So the Laguerre RSI, and it's interesting because I've now been using it. We'll look at Catalyst Pharma. All it's giving me is a signal about a swing. It's telling me that this stock, come on now, that's not what it's supposed to. You go to Market Watch, I just hit the wrong thing. Let's see. Let's just do this. Tap this. All right. AZN. When it's green, it should tell and give me a long signal. I should see it coming up off the bottom. If you look at the chart, it's typically reversing from a pullback. It just gives me more signals. To me, the critical parts here are the seasonality indicator and the columns showing me, is there any seasonality in the upcoming 20, 40, 60, or 1, 2, 3 month period. So package number 1 that he offered, and these again, you can go to his website, seasonalitytraderpro.com, and you won't find these prices. Package number 1 includes Laguerre and the stochastics and the tools in that 20, 40, 60 day period of time. He offered that for $9.99. For $17.99, which I know is steep for you, but I paid more than that for just the indicator piece alone. You get everything there plus the indicator, and for $2,500 he includes mentoring. I highly recommend the indicator and the watch list scan. It has a price on the web of $6,000. He commonly has discounts for 50% off sales. At $17.99, you're well off the 50% off. I bought it at the 50% off. So just something to think about. And lastly, I use these every day in TOS. One-time fee, no continuing data fees. You get updates, improvements. I actually paid more for them, as I said. Like the person's package, I don't take $1 on any sale to a third party, meaning you. Instead of paying me a marketing fee or commission, Dr. K took those off and reduced the fees. This is not about pressuring you. There's no impact on HGSI. This is not in your program. I don't need to see bantering on the websites about Dr. Scott's charging me more money for HGSI. I am not. And not that I have anything to do with what you pay for HGSI or your payment. If you're interested, email me at hgsidoc@gmail.com or contact Dr. K at seasonaltraderpro.com. Mention that you watch my video for HGSI and you'll get the special price. I had a number of you ask for that. That's why I did it. And one of you jumped the gun already, which I thought was hilarious. All right. So we've looked at the market from a Thinkorswim perspective. You know, in TradeStation, let me just give you a quick aside. It's not necessarily the same implementation, but I did find a Laguerre RSI for TradeStation on the web. It doesn't have the scanner. It doesn't have his modifications. But, you know, it's an interesting thing because when it crosses above the green line, which is what you use in thinkorswim, it does show you reversals of pullbacks. I'm still learning about it. I know he's going to come out with a version with a scanner and a radar screen for a trade station. Again, that's kind of what I would buy it for. And then I am playing with a beta version, which is not commercially available yet, of his scanner indicator for TradeStation. I've been helping him out a little bit. I'm trying it out. It's interesting. I think his tools are very compelling. Yes, the retail prices are high, but as part of the package that he's offered you, I think it's very reasonable. Now, in TradeStation, E-minis, we had a new sell signal come in on a daily. We're still in a weekly and monthly buy. We've gone to a red bar. And when I see that red bar, that tells me that I can be short or holding. I shouldn't be chasing a lot of long positions here. And I feel that that's true right here, and I'll be watching it very closely. And I don't think I'm going to want to buy a lot of long things at the open on Monday. Of course, the futures could be up 400 points, and this doesn't really matter because there could be some more quantitative easing. What I really want to show you is, what did I tell you last week? I said last week when my high jump bar starts to get high, the market's going to roll over. And if you look down here in that little window, you could see on the 13th, 14th, 97, and then the 18th. The high jump bar peaked on Monday, and the market really didn't move much further, and that sort of gave me a signal, and that's why I started buying the contra ETFs. The high jump bar works every time. Went back up to 96 on Wednesday, and now it's down to 75, and it no longer counts. You can see the daily bongo has gone red. Why doesn't it count? Because it's not an extreme anymore. So this is the E-minis. If I look at the Dow futures, we actually had a sell signal earlier, and their high jump is down in the 60s, so no more signal. The NASDAQ, which was even higher, if I remember correctly, right here was at 100 on the 19th. You don't think this on Wednesday said to be very nervous? I told me that. And it dropped to 89 with the market sell-off on Thursday. And then on Friday, it's down to 75. So that high jump works. And it's something that has protected me over time. And I didn't develop, maybe I changed it a little bit and brought it to other platforms. That's a best of Ian Woodward. Interestingly, I didn't look at the NASDAQ had a sell signal on Friday, and the weakling, the Russell, which has been the laggard, has not given us a daily buy signal, but as a sign of how it's been longer term weaker, it's actually in a weekly sell. So the markets look a lot weaker today than they did a week ago. Some of this is probably good as some of the steam will come off. The dollar, the high jump bar works on other things too. And on Thursday, the high jump bar on the dollar was 100. So on Wednesday, it was 100. On Tuesday, it was 100. On Monday, it was 90. It ended up the week after falling back at 78. The high jump, the reason why Ian came up with a high jump, there's some guy that had a something very pop flop, and he had set a mark that lasted for years. And what Ian taught us is when you get something that's hardly ever broken, when you get up to that point, it's probably not going to be broken again, and the market's going to fall back. And so I use the high jump. That's on the dollar. And just out of curious, with a weaker dollar and with increasing concerns, look at where gold is. And gold is on the high jump, interestingly, it's only at 92, so it might get higher, but gold is clearly getting extended. These red dots tell me that there's MACD divergence, and if you look at the peak on this high and the peak on this high, clearly there's a lag there. Gold looks interesting here and has been interesting, as his silver. And I guess just to go back to gold for 1 second, this is a monthly chart. We have taken out our highs all the way back to this bar here, and this bar is in 2013. We are at 6-year new highs on gold. That's a change in the market. Now, I made a comment, or I make comments often that I think that the markets are probably still going to go higher. And we do some very short-term analysis on these calls or these videos. But I've also made comments multiple times that most of my money is made on holding things longer. So I just want to give you a taste of some of my longer-term charts that I look at. I start with weeklies, and all I've done here is I've taken in green the 20-day, in yellow the 30-day, and in red the 50-day moving averages. And in a bull market or a rising market, you should see the green on top of the yellow on top of the red. I've got the Dow, the NASDAQ, the S&P, and the IWM. In the setting of the green above the yellow above the red, I'm still bullish on the weekly. Below it, I'm looking at the MACD. And if the blue, which is the MACD, is above the white, which is its average, that's bullish. And if you go back in time and you look at those periods of time when all four indexes are doing this signal, that's been a very bullish time in the market when you've looked at 3, 6, 12, and 24 months. If I look at the weekly charts, or excuse me, the monthly charts, and now I'm looking at just a 10 and 15 monthly moving average. I mean, these are months. You can see that we are in a bullish configuration on the monthly MACDs. If we look at that, even the Russell has gone to a bullish configuration. If you go back in time, this is usually something that predicts a fairly substantial move to the upside. If you look in HGSI, now I've taken a chart and I've just put on a number of moving averages. And here is the S&P 500. And what I have found, all right, first thing is the high jump is concerning here, and that tells me we're getting extended. But as long as we are moving above these lines and that the moving averages are from shortest to longest, that the market is usually in good shape. That doesn't mean you can't have 4, 7 to 7% pullbacks, but I still want to be long. When the market goes into the moving averages, it starts to get more painful. When the MACD is beneath the center line, it becomes more painful. Well, our MACDs are higher and in the bullish configuration. The moving averages are in the bullish configuration. And what I see is each time that we had much of a pullback, we've had bingos. Well, we haven't had a bingo fire since August. A bingo is when Ian signals a baby out with the bathwater. My concern here is we did have a Hindenburg, but if you look at over time, the Hindenburgs didn't always immediately call a top in the market. And the bond goes green. So I don't see a whole lot to think that this market is done. And we'll see where we go from there. I'm going to open up my designer. I'm going to go down to market analysis, user groups, major markets plus. I know Ron has updated these. Eventually I'll update his stuff as well. And I'm going to go to the top-down view. Now, for those who are saying, my God, everything is small. Yeah, I know that. I face this question every time I do these videos. If I do it in 1920 by 1080p or P, full HD, I can't get nearly as much on my screen. I know more and more people are getting 4K, so I've decided to do these in 4K. And in fact, my live webinars, I'm very tempted to do it 4K. All I can tell you is you can download it from YouTube. If you have YouTube Downloader, you can download it from my Dropbox, and I think it will play in whatever resolution you have. And YouTube does offer multiple resolutions. So let's take a look here. Top-down view, make sure I'm ranked by combo. So what do I see here? Well, first thing that comes out and smacks me in the face is look at where semiconductors are, pulling down the NASDAQ and the NASDAQ 100. The IBD 100 or 50 Innovator Fund is bad. Then up at the top, I got gold and bonds and silver. Interestingly, biotech has been working. So what does that tell you about a high growth stock portfolio? It tells you that Jeffrey was smart to put on protection, because that is not the kind of market that a high growth stock portfolio does well in. Little bit about my add-on right now. I have not updated my regular add-on, so you probably see some but not all of this. I do not plan on updating this because I incorporate those John Person indicators. I'm not taking off my add-on, but so those that have the John Person will have 2/16/2020, and I basically don't have a lot of charts here. I use this one for my daily, and I use my weekly is in there as well. I know it's a departure to not have, this one actually is in there without the PMC, but I want to use what I use. I don't want to use something that's less effective than what I use. And you can follow along and use whatever view you want to have. And obviously Ron has his views. And I know I've caught heat in the HGSI community, and part of me was pissed and the other part of me just laughed at the nonsense. HGSI is a tool. If you can make that tool better, you should. And if there's a commercial opportunity, then if we think it's better, we'll buy it. And I brought what I thought was good to the tool. And those that bought it, congrats. Those that didn't, you still got the same tool you always had, and it's a great tool. So let's take a look at the S&P 500. And I don't think I need to spend a lot here. We talked about it last week. I think, and I always like to look at three roads. Where did I learn this from? The master himself. I think the most likely scenario is we go back and visit the 50. That looks like, oh, you're not going to tell me today. Let's see if I can do that. Maybe it doesn't like doing that on the arrow. If we go back and we visit the 50, we're looking at another 2 or 3%. Does anybody not think a 2 or 3% change would be reasonable? The very low road is we go down here and we test the 200. That's only another 8%, so that would get us about 10% off the top. I don't think that that's unreasonable. Probably the most unreasonable is to just think that we're going to go up and set new highs. We certainly could, but as I said last week, and this is sort of panning out what I thought, it wouldn't surprise me for us to start going sideways a little bit before we either resolve it to the upside or the downside. I'm still playing that. That means it wouldn't surprise me if we're living in a box here, and we'll see where we go. But for right now, I think that the best we can hope for is a sideways move. But I can't ignore the fact that the central bankers can come out and ease at any time. So no surprise, just like in TradeStation, our person indicator went to a sell. Our bongo, which is a long-term trending indicator, is still long, which is interesting. If I look at the Dow Jones Industrial, just for completeness sake, looks just like the S&P. I don't see or anything different there. What does look a little bit better is the NASDAQ. I think the biotech's propped it up, although the NASDAQ still sold. Notice it's above, nicely above the 17. And then if I look at the Russell, it's the loosey-goosey of them all. This is an ETF, sideways. So markets clearly have paused their up move. They don't have to go down. I just think there's some risk there. We know the dollar sold off on Friday. You can see it in HGSI. I mean, is that a evening star? I don't know. Probably not because of this. It's certainly what we call a low close doji on the daily. And that's John Person's version of that. And that's a very useful signal. The interesting thing is we haven't gone negative on the Person market catcher yet, so we shall see. So this has held up a little bit better than the indexes, but it certainly sold off on Friday. Volatility, we talked about going up, and you can see here on the VIX futures, the volatility index, that it popped, sort of a spinning top there. We'll see if it can break out and go to new highs, which will be bad for our portfolios, or does it drift down? And with weak dollar and concerns worldwide, the change this week is not that gold is up. Gold had a great week, but I mentioned the last couple of weeks that I was bothered by the fact that gold miners hadn't done much. Well, they did starting on Tuesday. Signal on Tuesday in a breakout. Gold miners had a very strong week. And Nugget's going to reflect gold miners, not just GLD. Typically, they go lock, stock, and barrel. Silver Trust almost looks like a shooting star, but like gold miners, silver popped this week as well. Now, many of us trade high growth stocks, so I think it's interesting always to look at the 50, the Innovator IBD 50 fund. This is a ETF. Actively managed of the stocks in the IBD 50. So if your portfolio mimics the IBD 50, and I don't want to be mean because I did start with CanSlim and I subscribed to the IBD. You've been in a box going back to the middle of January. It's a sideways move. What's different than the IBD 50, and I don't know anything about this ETF, but it's the momentum stocks in the S&P 1500. And this one pulled back this week, but certainly a little bit different picture than the IBD 50 has been performing better. But all these indexes look tired. All of them have given you some pullbacks. And again, you have to have your own projection of what you think the market's going to do. Now, if I look at industry groups, let's see if I have to switch it. You could see that we started with 175 industry groups. Only 22 made it to my winners list for 2-day force up. I've got 40 to the downside, including the semis, infrastructure, internet, exploration, autos, e-commerce. The traditional growth stocks got pummeled there. If I look at 5-day down, I've got 54. And 5-day up, I only have 36. So not quite as ugly as the 2-day. That just tells me that over the longer period of time, we've been doing okay if you're long, but we did take a hit this week. The last I want you to do is write down a list of 50 stocks to go long with and be ready to buy them on Monday, because it's probably not the right market for that. So I'm clearly not saying that's what you should be doing. I hope. All right, so let's right click on precious metals, change to industry groups. Let's just look at a couple of these. EGO had a big breakout on Friday, a buyable gap up, a kahuna. Its person signal actually went positive several days ago. Break above the 50 on Thursday and Wednesday. You could have bought it there. Probably can still buy it here if you believe in gold. Look at the growth rates for this stock. Big PE, but really big growth rates. No dividend. Earnings are already out. I suspect they came out, and that's why it popped. Newmont has been in a big bull run, kind of extended. Barrick Gold broke out this week. Broke out of pretty substantial prior resistance. Kinross Gold, a less expensive gold, breaking out. AU, a little bit lagging, but I think getting ready to break out as well. I've been playing it with some of these, but my biggest position now is in Nugget. And, Nugget has good seasonality right now. Although the best period is probably ended to buy Nugget. It doesn't show up, doesn't have enough years trading, but you can see that if you follow this indicator, it would have gotten you long here as it was breaking out. Nugget is how I've been playing that back. Renewable energy, gosh, I want to kill myself for not being in Enphase. Enphase had blowout earnings. I don't know why I'm not in this. It's got all the things that I like about a stock. Here you had some improvement in the PMC, a person buy signal, kahunas, squeeze. I've been in it in the past. I wish I was in it now. Would I buy it and chase it here? Look at the multiple and look at the growth rate. It's probably not done going up. It's just a much higher risk play, especially if the market's going to be risky. Solar Edge popped on on Enphase and then went crazy on its own earnings. So Solar Edge looks good. I mean, there's a lot to like in this group of renewable energy. Those are the two above the index. Plug Power, which this has been a penny stock forever, actually bumped on the news. I have a hard time chasing that one. Algonquin, this was an interesting pattern, but again, I wasn't following it. You can't follow every stock in the book. But had I been, I would have noticed that you have a convergence on a flat base. You had a buy signal on John Person come in. You had a kahuna, and you had a squeeze and a mobile breakout. That should have been a signal to buy. I can't follow everything. I apologize for that. It's moved up about 20%. It's probably getting extended as well, but that's one of the areas with a lot of strength. But interestingly, despite all that strength, First Solar had bad earnings, and you could see it's not good everywhere in this patch. Healthcare supplies, these are up for this coronavirus scare. And these are a lot of dinky little companies. Don't know this company at all. Avidel, you're talking about a company with 14 million revenue. That's nothing. My private company has much more than that on a quarterly basis. And this is a public company, but you've got the coronavirus scare. I'm sure it's going to pop their revenue. And you had a buyable gap up. I don't know if I would be chasing. It's interesting. Becton Dickinson, they make supplies. Sort of a more stodgy, boring old company. A lot lower risk place to buy, but one that's not been performing well. You have Alpha Pro Tech. This one did the same thing during the last epidemic, as H1N1, whatever the influenza outbreak was. It had the same thing with Ebola. And I can tell you, I got a package from Amazon. To my wife, I go, "Did you order something?" No. Turns out it was a box of masks. And the reason we had them is my son, who's living in Taiwan, can't get Amazon to ship to him. So apparently he ships to us, and he gets prime free shipping from his mother. So these guys make gowns and masks, and you could see clearly some strength coming in here. But I expect these to do what they've done in the past, which is they have their day, and then they go back down to their resting state, which is about $3 a share. So be careful chasing things like this. All right. REITs, this is probably the place to be hiding this week. Last week I had a bunch of these on my buy watch list, including Digital Realty, which has broken out and is probably getting a little bit extended for my taste. Ventas was on my list last week. It had a nice move on Thursday and Friday as the market became dangerous. Pays a 5% dividend, still on my list this week. Simon Property, I'm not a big fan of the supermarket, the shopping center REITs. Pays a 5.9% dividend. Equinox is an expensive one, so I'll pass that. Crown Castle, they make some of the towers for cell phones, as does Towers, another REIT. Cyrus One, they make the I talked about this last week, and it had a move up on Thursday and Friday. Didn't do much in the beginning of the week, actually traded down a bit. They make the server farms, or they store server farms. So REITs continue to look good. I may have one or two on my buy watch list this week. Hint, hint. Healthcare facilities. I'm not sure if this is up because they passed some Medicare payment laws where there are small increases and not decreases. But look at where a couple of these stocks popped. This here is Community Health Systems. I wouldn't be playing it now. It's had a big move. Select Medical broke out as well. Tenant Healthcare, a spinoff of Columbia HCA. I mean, if you want to look at this and say flat base and less and a person convergence, maybe that's setting up. It's got great earnings per share growth. This might be worth looking at. Throw that in my buy watch list. Universal Health looks interesting as well. New person buy signal, mobile breakout, and a kahuna. I guess people, I don't know, maybe they just think somebody's going to need a place to go when they get their coronavirus. Base metals up as well with the weakness in the dollar. Century aluminum, kind of too low in the pattern to interest me. And this is Constellium. I don't know anything about it. It broke out on Thursday. No dividend, great earnings per share growth coming in. U.S. Steel is not here, but it showed up on a couple of my lists this week. You know, at some point you have to look at a franchise like this and say, should I be buying U.S. Steel? Now, on Wednesday, it had a mobile breakout from a squeeze. On Thursday, rather. On Wednesday, it had a person buy signal and a kahuna. Clearly, it's got a convergence on the person market catcher. Its fundamentals suck, but maybe that's a good thing because when the fundamentals were strong, the stock kept falling. And out of just curiosity, if I stick this in one of my John person screens, this is different than when I show you on the indexes. I just want to look at his volume indicator, which I'm trying to get him to give us in HGSI. The volume is crossing over its moving average here on the OBV and on his volume indicator. Clear convergence on the person market catcher. I mean, I don't usually advocate buying things in long-term downtrends, and I'm not advocating this, but at some point this is going to become an interesting product. Maybe it is now. Food and drug stores, Rite Aid, probably up there with Sprouts Farmers Market. I don't know the story on this one. It's got good earnings coming in this quarter. Next earnings are due out till May. Had a big gap up below the 200-day moving average, so it didn't trigger a gap up. Rite Aid had a big run, kind of that plug power picture. Is it getting ready to run again? I don't know. Not my stock. And then Kroger's popped probably because Berkshire Hathaway came out and said it has a big position in it, which might be reason to look at it. We found some stocks going through. We're at number 8. We'll look at large pharma. I like J&J and AbbVie here. J&J is pulled back into the 50, which is a place that I usually like to buy. I'd like to see it get some momentum come in here, but it pays a 2.5% dividend. AbbVie, which has a little bit more risk in 2 or 3 years from patent expiration, has taken off again. I owned it on this run. I didn't own it over here. It pays a 4.6% dividend as well. And I also liked AstraZeneca. So Big Pharma looks interesting, maybe because of their dividends. Here's 2.7. They've got a burgeoning oncology portfolio. Clearly, they were behind the market when it came to Bristol Myers Squibb and Merck. But believe me, they're catching up. And if I didn't have non-disclosures with them, I'd probably be buying them. I don't have any inside information. We just, as a company, when we do work, I don't trade them. But AZ looks very interesting to me right here. Being a cancer doctor, I can't buy tobacco, so I'm not even going to look at it. Let's just look at other specialty retail real quickly. And here you see Carvana. I've seen a couple of their car concession stands. Interesting idea. All right, so we've looked at a bunch of stocks. We actually found some that looked compelling. I think the story is defensive, whether it's a REIT. I didn't look at many utilities, so I don't buy them typically. Whether it's alternative energy, whether it's a metal like gold. And then let's just take a look at my buy watch list. And Big Pharma is a flight to safety story. So on my buy watch, I actually had 41 things that looked interesting. I didn't say they looked good. I said they looked interesting. If I look at the industry groups, you'll notice I got a bunch of specialty pharmas. If you think about it, biotech has done well, and these behave like biotech. The formal biotech I have is Cassava Sciences. I just like the pattern here. Pull back to the 50. A kahuna, something to at least watch. I got the large pharmas, AZ and J&J. From a retail perspective, I thought Dollar General's chart looked very interesting. Sideways moved down to the 50, and of course I didn't tell you about this last week. I wish I would have, but mobile breakout from a squeeze, a new person buy signal and a kahuna, and look at the convergence of the person market catcher. You look at the weekly chart, it's approaching its all-time highs. It had a big move last week. 5%, probably not too late to start looking at Dollar General. And then if you like Dollar General and you want something more timely, how about Walmart? Earnings were not great, but their digital story is good. Their growth is good. And look at person market catcher here, converging despite the stock sideways here. Did person market catcher know that the earnings would be viewed as positive? So this is the list. There's the silver, wheat, and precious metals. You can see why I'm in this. It broke out here. So, as I've said multiple times, I shouldn't call it a buy list. It's a watch list. And what I will do is I will place that watch list, for example, in Market Watch, Buy Watch, and then I have this thing is proprietary, so I can't give it to you. But when it fires a 1, it's something that I pay a lot of attention to. I have kahunas here from my friend Bob. I've got HCDs and LCDs, but it's not the same as in Hgsi or in TradeStation. I've had a very difficult time getting them to match up with John's signals. I do not share those. Pocket pivots. I have pocket pivots and Bible gap ups. But now I have the daily RSI from Dr. K. I have his stochastics as well. Then I have the signals here. Does anything have a good performance? And I look here and I see Gartner Inc. has a daily lag RSI that's telling me it's signaling a buy, which means it's reversing right now. Earnings are not out until April 3rd, so I got time. So I'm going to click this red box here. I'm going to look at the chart, and I'm going to see that it just broke above here. Look at the seasonality. So I might want to watch Gartner. So I integrate these tools. I will watch my buy watch list during the week. I'll add stocks to that. I have a more extended buy watch here that I'm going to be looking for signals on as well. And then if you're a TradeStation person, it's even better, in my opinion, because in TradeStation, I could put John stuff here, and I've got Hgsi, Q, and John stuff all sitting here. And one thing I do want to point out that both in TradeStation and Thinkorswim, I have an earnings indicator that tells me what's got earnings coming, because again, you can hold them over earnings, especially if you made a lot of money, but I certainly would not be entering new positions the day of or a few days before earnings. On that note, I'm going to say goodbye. Have a great rest of the weekend. Talk to you next week, and email me at hgsidoc@gmail.com if you'd like the links for Dr. K's gracious discount to my followers. Goodbye.